87% of traders set their stop loss in the wrong place before the trade even begins. Not before they move it, before they place it. The damage is done at the moment of calculation, not at the moment of fear. And this distinction is the reason traders who have studied stop-loss discipline, who understand why you must never move a stop once a trade is live, who follow that rule with real commitment, still lose money on positions their analysis called correctly. The stop was moved before it was ever placed. It was moved backward, from the desired dollar loss to an arbitrary price level, rather than forward from where the analysis was wrong to the correct position size. That reversal of sequence, that single error in the order of calculation, is what the 87% have in common. This video is not about whether you honor your stop once the trade is live. That is a different problem for a different day. This video is about the 5 specific mistakes traders make when they set the stop in the first place, and the exact protocol Livermore used to place stops that were never based on what he was afraid to lose, but always on where the market had definitively spoken against his position. Here is the difference in plain language. An amateur decides how much they can afford to lose on a trade, perhaps $200, then divides that by their intended share count to arrive at a stop distance, and places the stop at whatever price that calculation produces. A professional identifies the structural level at which their analysis is definitively wrong, the price the market must not touch if the trade premise is correct, and then calculates how many shares to hold so that if that level is hit, the loss is exactly 1% of a count. Same outcome in dollar terms, completely different stop location. And the stop location is what determines whether the trade lives or dies before direction is ever proven. A stop placed at the wrong level for the right reason is still the wrong stop. Let me tell you about Raphael. Raphael had been trading for 2 years when he identified the pattern that was quietly destroying his account. He was not moving his stops. He had that discipline. He was not oversizing. He had that formula. His entry analysis was, by any honest measure, correct more often than it appeared. The problem was discovered when he went back through 8 months of losing trades and measured one specific variable. At what point in the trade's life did the stop get hit? What he found was this. 71% of his stopped-out trades had been exited within the first 15 minutes of going live. The market had not turned against his analysis over the course of a session or a day. It had hit his stop almost immediately, in the opening minutes, during the initial noise and probing that follows every entry in every active market. His stops were set inside the instrument's normal activity range. They were being hit not by reversals, but by the routine price testing that precedes nearly every directional move. He was being removed from correct positions before those positions had time to prove themselves. His win rate was 39%. His profit factor was 0.88, meaning for every dollar he lost, he was recovering 88 cents. His account had declined from $15,500 to $12,800 over those 8 months, despite analysis that the chart later confirmed was directionally accurate in 64% of cases. He was right. His stops were wrong. And the difference between those two numbers, 64% analytical accuracy and 39% win rate, was the account that had quietly vanished. Here are the 5 mistakes. They appear on nearly every chart, in nearly every trade, from nearly every trader who has never been taught the correct sequence. Mistake 1, the backward calculation. This is the source of all the others. When a trader begins stop placement by asking, "How much can I afford to lose?" they have started at the wrong end of the calculation. That question produces a dollar amount. The dollar amount is divided by the intended position size to produce a stop distance. The stop distance is subtracted from the entry price to produce the stop level. The resulting stop level has one characteristic. It limits the trader's dollar loss to a predetermined amount. It has no other characteristic. It has no relationship to price structure. It has no relationship to where the analysis is wrong. It is a number generated from financial comfort, not from market reality. And markets do not move based on your financial comfort. They move based on supply and demand, and supply and demand will probe, test, and probe again through the level your backward calculation produced, regardless of what your financial preference had to say about it. Livermore never started a stop-loss calculation with what he wanted to risk. He started it with where the market would prove him wrong. The pivotal point, his term for the structural invalidation level, was the foundation. The position size was the result. The dollar risk was the output, not the input. That sequence is not a technicality. It is the entire architecture. Mistake 2. The round number trap. Stops placed at $50, at $100, at any clean, even round price level are stops placed in the most hunted location on the chart. Price is statistically more likely to probe and reverse at round numbers than at any other price level, not because of chart magic, but because of the identical psychology that put the retail stops there in the first place. Round numbers feel significant. They are easy to remember, easy to calculate around, and easy to choose as a stopping point. Every retail trader on the same instrument using the same basic analysis has arrived at approximately the same round number. Those stops cluster, and the institutional players who can see where order flow is concentrated, who can identify where stop clusters exist, probe those levels precisely because clearing the stops provides liquidity. The stops get hit. Price reverses. The retail trader exits the position. The institution buys their shares at the forced exit price. 10 cents of separation from a round number, in either direction, puts the stop in a location that was not chosen by every other retail trader on the same chart. That separation costs nothing and protects everything. Mistake 3. The noise level stop. Every instrument moves within a range on every session, an average daily range, the typical distance between the day's highest and lowest price. A stop placed inside this range is a stop that will be hit by ordinary price behavior, not by genuine directional reversal. If a stock typically moves $2 between its daily high and low, and the stop is placed $1 below entry, the stop is inside the normal daily noise. On any average session, the market can move $2 without committing to a direction. The $1 stop gets hit in the middle of that $2 noise range, not because the trade was wrong, but because the stop was placed in territory the market passes through every single day without making a statement. Raphael's 71% within 15 minutes stop rate was the signature of this mistake at its most extreme. His stops were inside the opening range noise, the first 15 minutes during which every actively traded instrument tests both directions before committing. He was setting his stop at a level the market probes as a matter of routine. And every routine probe removed him from a position his analysis had correctly identified. Mistake 4. The exact level stop. When a structural support level exists, a prior swing low, the top of a base, a trend line that has held multiple tests, the obvious stop is immediately below or above that level. And placing the stop exactly there, with no buffer, is placing it in the path of the probe that will test the level before the bounce occurs. Support levels are not walls. They are zones of interest where buyers have previously appeared. Price tests those zones, sometimes briefly breaking through before reversing, because the test is how the market confirms that the level still holds. A stop placed exactly at the level is triggered during the test. A stop placed beyond the test zone, below the probe area, not at the surface of the level, survives the test and holds through to the confirmation. The buffer is not padding. The buffer is the recognition that levels are zones, not lines. A structural level that held at 47.50 last month does not guarantee that price will reverse at exactly 47.50 this time. It guarantees that buyers are likely to appear somewhere in the vicinity of 47.50. That vicinity has a width. The stop needs to be below the vicinity, not inside it. Mistake 5. The identical stop for every trade. A fixed percentage applied universally, 2% of account on every trade, regardless of instrument, regardless of volatility, regardless of setup quality, treats every trade as though it exists in identical market conditions. It does not. A 2% stop on a bond ETF with an average daily range of 50 cents is a stop sitting far outside the noise. A 2% stop on a high volatility growth stock with an average daily range of $4 is a stop sitting squarely inside it. Same percentage, completely different relationship to the instrument's actual behavior. Stop placement must account for the instrument's typical movement, not be derived from a percentage that was convenient to remember. An amateur uses the same stop percentage on every trade. A professional calibrates the stop to the instrument's specific volatility profile before anything else. Now understand why the backward calculation persists, despite how clearly it fails. Because the psychology beneath it is one of the most powerful forces in trading. Loss aversion, the well-documented neurological response in which the pain of losing a dollar is felt roughly twice as intensely as the pleasure of gaining one, creates direct pressure on the stop placement decision. The closer the stop, the smaller the maximum potential dollar loss. And the smaller the maximum potential dollar loss, the more the brain's threat response quiets down. The backward calculation is, at its core, an anxiety management strategy. The trader is not calculating where the market is wrong. The trader is calculating the minimum possible pain and calling it a stop loss. Charts never lie. The lies come from your fear, your greed, and your impatience. Placing a stop based on fear of a specific dollar loss is placing it based on a lie about what the market is doing. The market has no knowledge of and no interest in your dollar threshold. It will probe the structural level regardless. The stop that survives that probe is the one placed beyond it. The stop that does not survive is the one placed where the trader's anxiety told them the pain would be acceptable, which is almost always inside the probe, inside the noise, inside the level, and inside the pattern that the market executes before every valid bounce. An amateur places the stop where the loss would still feel manageable. A professional places the stop where the analysis is structurally wrong. Here is the 5-rule protocol. It is written in the correct sequence. The sequence is non-negotiable. Rule 1. Find the structural invalidation level before any other calculation begins. Ask one question. At what price is my analysis of this trade definitively wrong? Not uncomfortably wrong, not nervously wrong, definitively wrong, where price behavior proves the premise was incorrect. That price level is the foundation. Nothing else is calculated until this level is identified. Rule 2. Add the average daily range buffer. Calculate the instrument's ADR, the average of its daily high minus low range over the past 10 to 20 sessions. Add 10 to 15% of that number beyond the structural invalidation level in the direction of your trade. If the structural level is at $47.50 and the ADR is $2, the stop goes at $47.20 to $47.30, not $47.50. The buffer absorbs the probe. The structural level identifies the zone. The buffer places the stop beyond the zone. Rule 3. Check the stop against the round number list. If the calculation produces a stop at $50, $49.50, 100, or any round number within 20 cents of your calculated level, move the stop 15 cents further in your favor. One specific number in a precise location is worth more protection than any indicator overlay. Get off the crowd's stop level. Stay off it permanently. Rule 4. Verify the stop distance against the ADR. Measure from entry to stop. If the distance is less than one full ADR, the stop is inside normal daily noise. That trade does not have a valid entry point yet, because the structure has not created sufficient distance between entry and invalidation. Wait for the price to coil tighter, for the entry to improve, or for the structure to provide the room needed. An entry without structural room for the stop is not an entry. It is a scheduled loss. Rule 5. Calculate position size only after the first 4 rules are complete. Risk amount in dollars divided by stop distance in price equals position size in shares or contracts. This calculation happens last. The stop was not built to accommodate the position size. The position size was built to accommodate the stop. That sequence is Livermore's sequence. It is the only sequence that places the stop where the market speaks rather than where the trader fears. The man who cuts his losses quickly earns the right to hold his winners patiently. The only way to cut losses quickly is to place the stop where a genuine loss is confirmed, where the market has moved far enough against the position to prove the analysis wrong, not far enough to trigger the fear response alone. A stop placed correctly means every exit is a genuine signal. The analysis was wrong, and the market confirmed it. A stop placed backward means most exits are noise. The market tested a zone, triggered a stop that had no business being there, and continued in the original direction without the trader. Raphael's account, 7 months after implementing all 5 rules, held $26,800. From $12,800, the low point produced by correct analysis and incorrect stops, to $26,800. A gain of $14,000 in 7 months, using the same instruments, the same setups, and the same entry signals he had always used. What changed was not the trade. What changed was where the stop told the market it was wrong, and giving the trade the structural room to be right before the market passed judgment. The level defines the stop defines the size defines the risk. In that order, every time. 87% of traders set stop losses wrong, not because they are careless, but because they start from the wrong place. They start from what they are afraid to lose. Start instead from where your analysis is wrong. Those two numbers are different, and the distance between them is where most accounts quietly go. If this describes how you have been calculating your stops, if you have been starting from the dollar risk and working backward to a stop level, type wrong end in the comments. And subscribe now because the next video covers the complete pre-session checklist that combines structural stop placement, the spot and enter framework, and daily position sizing into one routine that takes under 20 minutes and prepares every decision before the market opens. The market told you where the stop belonged. You were listening to your fear instead.